Hi everyone, my name is Nick and welcome to the first episode of our brand new series where we will analyze every chapter of Benjamin Graham's The Intelligent Investor. Now let me tell you something amazing. Warren Buffett, one of the greatest investors of all time, personally recommends this book as the best book on investing ever written. If that's not reason enough to read it, I don't know what is. If you have ever wanted to truly understand this legendary book, chapter by chapter, and apply its wisdom to your investing journey, you are in the right place. If you don't already have a copy of The Intelligent Investor, I have added a link in the description where we can get your own. It's a must-have for anyone serious about learning how to invest the right way. Now, I want to make one thing clear. This video series won't replace you reading the book. Instead, think of it as a companion to help you along the way. I'll be here to break down the most important ideas and concepts in simple terms because, let's face it, this book can be a bit tough to understand at times. The Intelligent Investor contains hundreds, maybe thousands of powerful ideas. It will take hours to cover them all. So, in this series, I'll be focusing on the insights that I personally believe are the most useful, timeless, and actionable. We will start by analyzing the preface, written by none other than Warren Buffett himself. Let's break it down together. In the preface, Warren Buffett says something incredibly powerful. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insight, or inside information. What is needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must apply the emotional discipline. Let's unpack this. Buffett is telling us that successful investing isn't about being the smartest person in the room or having secret knowledge that no one else has. Instead, it's about having two key things. 1. A reliable framework. This means having a clear and logical system for making investment decisions. The Intelligent Investor book provides the system, teaching you how to assess the value of an investment, manage risk, and make decisions based on analysis, not emotions. 2. Emotional discipline. This is arguably the harder part. Even with a great framework, emotions like fear and greed can derail you. For example, when markets crash, many investors panic and sell at the worst possible time. Or when the markets soar, greed drives them to overpay for stocks. Buffett is emphasizing the importance of staying calm and rational, even when everyone else is losing their cool. Buffett credits the Intelligent Investor book for prescribing the perfect framework to follow, but he's also clear that it is up to you to supply the emotional discipline. Without it, even the best system in the world won't help you succeed. So, as we dive deeper into the book, keep these two principles in mind. Master the framework, master yourself. In the next part of the preface, Warren Buffett highlights what truly determines your success as an investor. He writes, "Whether you achieve outstanding results will depend on the effort and intellect you apply to your investment, as well as on the amplitudes of stock market folly that prevail during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly, rather than participate in it." Buffett is making a crucial point. Investing isn't passive. It requires real effort, the willingness to think clearly, to stay disciplined, and to avoid getting swept up in emotion. He also reminds us that the market is irrational. It goes through periods of panic and euphoria. That volatility, what he calls folly, isn't a danger to avoid, but an opportunity to embrace. Here is how to think about it. The stock market is like a stormy ocean. Most investors are in small boats, panicking with every wave. But if you follow Graham's principles, it's like having a strong ship and a steady compass. You can't control the storm, but with discipline and clear thinking, you can sail safely while others sink. That's the essence of intelligent investing. You don't chase the crowd. You don't react to every headline. You wait, you think, and when the market loses its mind, you stay calm and you act with purpose. That's what I need you to take away from the preface. Now, let's move on to some notes on Benjamin Graham written by Jason Zweig, who provides commentary throughout the book. On page 3, he highlights Benjamin Graham's core principles, which form the foundation of value investing. Let's take a look at the first one. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. What he's saying is that when you buy a stock, you are not just buying something to trade, you are buying a piece of a real company. That company has real assets, makes money, or sometimes loses money, and has a true value that doesn't change just because the stock price goes up or down. The market price of a stock might swing wildly because of emotions like fear or greed, but the actual value of the company stays connected to how well the business is doing. If you understand this one idea, you are already ahead of most investors. Most people still treat stocks like lottery tickets, hoping for quick gains without really understanding what they own. But stocks aren't bets, they are ownership in a real business. And as Peter Lynch put it, behind every stock is a company. Find out what it's doing. If the company earns more profits over time, the stock will eventually go up. If profits shrink, the stock will go down. It's that simple. When you think this way, you stop reacting to price swings and start focusing on what truly matters. Is the business strong, growing, and well managed? This mindset protects you from panic and hype and sets you up to invest with clarity and confidence. Another key principle from Benjamin Graham is understanding that the market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. At times, investors get swept up in optimism and push prices far above a stock's true worth. Other times, fear takes over and drives prices unreasonably low. Graham tells us the intelligent investor stays calm while others swing wildly. Be a realist, buy from pessimists and sell to optimists. A perfect example of irrational optimism was the dot-com bubble. In 1999, Pets.com soared to a $300 million valuation with almost no revenue. Just a year later, it was bankrupt. The stock collapsed and investors lost nearly everything. On the flip side, in 2008, fear dominated the market. Amazon dropped over 60%. Coca-Cola fell nearly 40%, even though both companies remained profitable. Those who sold in panic took heavy losses, but those who stayed calm or bought were rewarded. Amazon gained thousands of percent in the years that followed. Coca-Cola steadily recovered while paying dividends all the way through. The lesson is simple. When the market swings wildly, stay steady. The calm, rational investor has the greatest advantage. The third principle of Benjamin Graham's philosophy is this. The future value of every investment is a function of the present price. The higher the price you pay, the lower your return will be. The third key principle is simple but critical. What you earn from an investment doesn't just depend on how great the company is, it also depends on the price you pay. Even an amazing business can deliver poor returns if you overpay. Take Microsoft. In the year 2000, at the peak of the dot-com bubble, investors were wildly optimistic and pushed the stock to extreme valuations. Microsoft kept growing, but those who bought at the top had to wait over a decade just to break even. It wasn't until 2016 that the investment really paid off. Now contrast that with someone who bought Microsoft during the 2008 financial crisis. The business was still strong, but the price was far lower. The return, much greater. Same company, two very different outcomes. Why? Because price matters. As Graham teaches, even the best business can be a bad investment if the price is too high. The fourth principle of Benjamin Graham's philosophy is the concept of the margin of safety, which he calls the most important rule in investing. Graham teaches us that no matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by investing on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. This principle is one of the most important pillars of value investing. The margin of safety is all about building a protective buffer to safeguard your investments from the unexpected. No matter how much research you do or how confident you are, there's always a risk that things won't go as planned. A company might face unforeseen challenges, market conditions may change, or your analysis might have flaws. By only buying stocks when their price is significantly below their true value, you reduce the chances of significant losses and create a cushion to absorb potential mistakes. If you think a stock is worth $100 and you can buy it for $70, that $30 difference is your margin of safety. It gives you a cushion, so even if your estimate is off, you are still protected. This principle forces patience. It keeps you from chasing hype, and it reminds you that investing is not about avoiding risk, it is about managing it wisely. Margin of safety isn't just a rule, it is the foundation of intelligent investing. Graham's final and perhaps most important principle is this: the secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith and you invest with pace and confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. You don't need to predict the future or chase trends. What matters most is how you think, how you react, and whether you can stay disciplined when others are losing their heads. Emotional discipline is like being a lighthouse keeper during a storm, steady, calm, and unmoving while chaos rages around you. Most investors don't fail because they pick bad stocks. They fail because they let emotions take over. Greed during bull markets, fear during crashes, panic when everyone else is panicking. True success, as Graham teaches, begins with mastering yourself. Your behavior matters more than your portfolios. Take Apple in March 2020. As COVID fears rattled markets, the stock fell over 30%. Many investors sold in fear, but those who stayed calm or bought more watched it double within a year. The company didn't change. What changed was how people responded. And that's the key: emotional discipline, not predictions, is what separates long-term winners from short-term regret. Now that we have covered the preface, let's move into the actual introduction by Benjamin Graham himself. On page 6, Graham points out a very common belief among investors. He writes, "It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. But this is not as easy as it always looks in retrospect. Spotting a growing market is easy. Most people can see when a sector is taking off, and they flock to it. But finding the one company within that sector that will survive and thrive, that's the hard part. Take the internet boom of the 90s. Everyone could see the internet was the future. Investors rushed into tech, assuming everything related to the web would explode. But most of those companies, like Pets.com and Webvan, collapsed. The trend was right, but the peaks were wrong or overpriced. Now think of Amazon. It also started during the dot-com era, but unlike many of its peers, it survived and thrived. Few investors had the patience or insight to hold it through early losses, fierce competition, and market crashes. And today we are seeing a similar pattern play out with artificial intelligence. AI is clearly a transformative technology, but just like the 90s, that doesn't mean every AI related company will succeed, or that every stock with AI in its pitch is a good investment. The excitement is real, but so is the danger of overpaying or picking the wrong player. Graham's point: picking winners isn't as easy as it looks in hindsight. And from this, Benjamin Graham gives us two timeless lessons, two morals as he calls them. Obvious growth does not mean obvious profits. Just because a business or industry looks like it is growing doesn't mean it will make money for investors. The market often gets ahead of itself, pricing in years of growth before the company has even proven itself. That's what happened in the dot-com era. Investors saw the potential of the internet but rushed to buy any company in the space, regardless of quality or price. Most lost money, despite being right about the trend. Growth isn't enough. What matters is what you pay for that growth, and whether it's actually sustainable. Even the experts can't reliably pick the winners. Wall Street analysts, fund managers, and tech enthusiasts all try to predict which companies will dominate in the next big sector. But history shows that even the pros often get it wrong. Out of dozens of flashy startups during the internet boom, only a few like Amazon and Google survived, and they were hard to spot at the moment. Graham reminds us, don't bet your financial future on expert predictions. And here is another classic insight from Graham. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago, we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. What does that mean? When you buy groceries, you think practically. You look at the price, you compare brands, you want value for your money. But when people buy perfume, it's often about emotion, fancy packaging, a nice story, or how it makes them feel, regardless of the price. Graham's point: too many investors treat stocks like luxury items, buying based on hype, popularity, or a good story, without asking the most important question: how much am I paying compared to what I am getting? This simple habit, relating price to value, is the foundation of smart investing, and it's the one most people forget in times of excitement or panic. In fact, Graham says that the worst investment losses often happen when people forget to ask how much, when they blindly chase hot stocks without checking if the price makes sense. So the next time you are tempted to jump into a stock because it is popular or going to the moon, stop and ask yourself, would I buy this if it were a bag of rice? Or am I falling for the perfume? That one question can save you years of regret. Right after Graham's introduction, Jason Zweig, who provides the updated commentary throughout the book, steps in to highlight a key point. He writes, "Are you an intelligent investor?" Now let's answer a vitally important question. What exactly does Graham mean by an intelligent investor? Back in the first edition of this book, Graham defines the term, and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This kind of intelligence, explains Graham, is a trait more of the character than of the brain. This definition completely reshapes how we think about investing. According to Graham, intelligence in investing isn't about being brilliant, it is about being stable. The intelligent investor is calm, disciplined, and patient. He is not swayed by hype or fear. He thinks clearly when others panic and sticks to his plan when others chase fads. This kind of intelligence doesn't come from schools. It comes from how you behave under pressure. And the best part, anyone can build it. You don't need a finance degree or inside connections. You need the ability to control your emotions, stay curious, and think for yourself, especially when the crowd is going the other way. So, when Graham talks about being an intelligent investor, he's not talking about your brain power, he's talking about your character, and that's something you can choose to strengthen every single day. Now, let's move on. On page 13, there is a story that proves just how powerful and dangerous emotions can be, even for the smartest minds in history. And back in the spring of 720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. Newton dumped his South Sea shares, pocketing a 100% profit, totaling £7,000. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in a much higher price and lost £20,000, or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us will define intelligence. But in Graham's terms, Newton was far from an intelligent investor. By letting the roar of the crowd override his own judgment, the world's greatest scientist acted like a fool. Think about that. One of the greatest scientific minds in history, Sir Isaac Newton, could chart the laws of the universe but still couldn't control his emotion during a market bubble. He knew it was a mania, he got out with a profit, but when everyone else got excited, he couldn't resist jumping back in. And that one emotional decision cost him more than just money, it haunted him for the rest of his life. If Newton wasn't immune to crowd psychology, what chance do we have unless we prepare ourselves in advance? That's why Graham's lessons on discipline and emotional control matter so much. Intelligence doesn't protect you from market madness, only the character does. And now the final passage I want to share with you from Jason Zweig's commentary on the introduction, a passage that completely flips the way most people think about risk and opportunity. The same people who were eager to buy stocks in the late 90s when they were going up in price and therefore becoming expensive, sold stocks as they went down in price and by definition became cheaper. As Graham shows so brilliantly in chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. So take heart, the death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. Read on and let Graham show you how. Let that sink in. Most people feel safe when prices are rising and terrified when prices are falling. But the intelligent investor thinks the opposite way. When prices go up, stocks become more expensive and more risky. When prices fall, they become cheaper and less risky. So while the crowd fears a bear market, the intelligent investor sees an opportunity, a chance to buy great businesses at discount prices. And that's the mindset shift this book is here to teach you, to stop following the herd and start thinking like a long-term owner. So that's the foundation of value investing. In just the preface and introduction, we have already uncovered some of the most important ideas in investing and in life. This isn't just a book about money, it is a book about how to think clearly when others don't, and to stay rational in an irrational world, and how to make decisions that actually stand the test of time. If you have made it this far, you are not just learning investing, you are building the mindset of an intelligent investor. In the next episode, we will dive into Chapter 1. Until then, I encourage you to reflect on what we have covered here. Think about your own habits, your emotions, and how you have approached investing in the past. If you found this video helpful, make sure to subscribe so you don't miss the next episode. And if you want a summary of the principles we just discussed, you'll find a free PDF companion guide linked in the description. I'll see you in the next one.